Hello, hello. Hello, testing. Okay. Cool. Testing. Okay. All right, welcome. This is day 8 of studying for the CPA exam section using my own study tool I created called CPAcioli, the CPA Exam Prep that you can actually afford. $19 a month starting, 7-day free trial, no credit card required if you want to test it out. And this is just me going over 30 now because we're doing an hour per session, 30 multiple choice questions for FAR using my study tools. So we'll click sign in here. And then these are all, the stats for the week and all time. And then we will go to practice. We're going to do multiple choice, unanswered questions, and all difficulty, all sub areas. Here are all the sub areas. So yeah, let's get right into it. So begin. Let's make sure this is going. Yes. All right. So like I said, we'll do 30 questions. It'll take us about 2 minutes a question. So we'll get done in about an hour and then that'll be it. So here we go. Under GASB standards, a state or local government's funds are classified into which 3 broad categories? I believe it's A. Okay, cool. And yeah, let me know in the chat if you have any questions, obviously, and I'll get around to it. So, yep. That's about all. See, government funds, GASB has government funds, and governmental funds, proprietary funds, and fiduciary funds. 3 broad fund categories used in governmental accounting. Awesome. Parent company owns 100% of sub company and accounts for its investment using the equity method on its separate books. So parents' retained earnings already reflects its full share of subs. Let's see. So I guess only the 700,000 should be reported on the consolidated retained earnings. Let's see. When the parent uses the equity method for its investment, the parent's separate entity retained earnings already fully reflects its share and the subsidiary's post-acquisition earnings. Consolidated retained earnings, therefore, simply equals the parent's retained earnings with no further addition to the subsidiary's retained earnings. Okay. Because parent uses the equity method, its 700 retained earnings already fully incorporates its share of subs post-acquisition income. So consolidated retained earnings equals parent's retained earnings with no further addition. Okay. Cool. Good to know. A city levies $5 million. Okay, so this should be the 4.8 plus the 150, so should be 495. Cool. That plus that, and the estimated uncollectible is not included. So yeah. Satisfying both the measurable and available criteria. But the 50,000 uncollectible is not included. Lake Spur Corp repurchased 5,000 shares of its Winona par common stock at $18 per share, recording them to treasury stock under the cost method. Was the credit to the additional paid-in capital when the shares are reissued? I believe it would be. Credit to the additional paid-in capital when the shares are reissued. So let's see the four difference: $80, 32. Say $4 difference times 2,000 is 8,000. I think 8,000. Okay. On the cost method, reissuance of treasury stock above cost credits only the excess over cost to additional paid-in capital. Treasury stock, never a gain account. Yeah, so it was just the difference. Now, if it was a different method, because this is the cost method, it would not be this. But since it's the cost method, this is what it is. So, and then for the reissuance, it'd be the debit to cash and credit to treasury stock and additional paid-in capital. Awesome. During the year, a company purchases 5,000 shares of its own common stock as treasury stock for $40 per share, and later in the same year reissues 2,000 of those treasury stock. So 200,000 minus 96,000, which is 104,000, and it would be an outflow because they purchased more than they reissued. So it should be B. Didn't even read it. Dang it. And then, let's see. Yeah, I didn't read the whole question. Because it's an outflow of 104,000. And then, since they purchased its own common stock, it's a financing activity, not an operating activity. I just didn't read the question because I thought that one said inflow of that. So lesson learned. But yeah, it would be an outflow of 104,000 and reported in financing activities. Not-for-profit museum maintaining a collection of historical artifacts. Is the museum required to capitalize these collection items on its statement of financial position? I'm not sure. No, it may elect not to capitalize collection items meeting the specified criteria, disclosing its policy and the collections. A not-for-profit is permitted but not required to elect not to capitalize collection items that meet specified criteria, held for public exhibition, education, or research, protected and cared for, and subject to an organizational policy that proceeds from sale of collection items are used to acquire other collection items. Permits a not-for-profit to elect not to capitalize collection items that meet the specified criteria, provided it discloses the collections held in its accounting policy. So they have the option if it meets that criteria. A retailer allows customers to purchase gift cards that do not expire and have no breakage expected. When should the retailer recognize revenue from the sale of the gift card? Yeah, because the revenue recognition principle. So when the customer redeems a gift card for merchandise, revenue is recognized only when a performance obligation is satisfied. For gift cards, that moment is redemption when merchandise is transferred to the customer. Simple enough. On January 1st, an investor purchased 30% of the outstanding common stock for $200K, giving it significant influence. During the year, the investee reported net income of $80 and paid total cash dividends. Okay, this is pretty easy. So significant influence of the equity method. So 30% of 80, you'd add that. So we'll do 80,000 times. So you'd add 24,000 and then you would subtract 30% of 20,000. So 24 minus 6 is 18. So 18 plus 200,000 is 218,000. So you just take the percentages. Pretty simple. Company purchases new manufacturing equipment and incurs the purchase price, freight and charges to deliver the equipment, and installation and testing costs to prepare it for its intended use. Under GAAP, how should these costs be treated? I think getting it ready for its intended use would be capitalized. So let's see. Purchase price would be freight and charges to deliver the equipment and installation and testing costs to prepare for. I think it would all be capitalized. Yeah, cool. All three costs should be capitalized because they are necessary to bring the asset to its intended condition and location. Purchase price, freighting, and installation/testing costs are all directly attributable to preparing the asset for its intended use and must be capitalized. In March, Rivertown Company transfers control of product A to a customer, satisfying that performance obligation under a contract that also requires delivery of product B before Rivertown has an unconditional right to bill the customer for either product. How should Rivertown record the $60K allocated to product A upon transferring control? I think it's A. Yeah, as a contract asset because the right of consideration is conditional on more than the passage of time, which is it's also contingent on the delivery of product B. Distinguishes a contract asset, conditional right to consideration, from a receivable, unconditional right to consideration, based on whether anything other than the passage of time must occur before payment is due. Because Rivertown's right to bill is conditioned on delivering product B, accounting requires this recognition amount to be presented as a contract asset rather than a receivable. Awesome. Nordic Company issued $1 million of 8% bonds when the market rate was 10%, receiving proceeds of that. The bonds pay interest semi-annually, and the company used the effective interest method. It was the carrying amount of the bonds immediately after the first semi-annual interest payment. All right, let's think about this. So it's at a discount semi-annually. So I think it would be market rate. So I believe it'd be market rate times this. So 875,378 times the market rate. Oh, hold up. The market rate divided by 2, though, because it's semi-annually. And then, so 43768 minus the 8% of $1 million is 80,000, but then you divide it by 2 because it's semi-annual, so it would be minus 40,000. And then you add this to the carrying amount. 879,146. I'm not sure. Let's see. So I did that. Oh, it's just an error there. Okay. All right, so we did it correctly. Nice. Yeah, it's just an error in that calculation, but we did it correctly. Cool. At the beginning of year 3, company changed depreciation method for a machine from double declining balance to straight line. The machine originally cost that with a 5-year useful life. Yeah, it's easy. 64 divided by 3. Cool. By the $36,000 remaining carrying amount by the 3 remaining years of useful life correctly yields $12,000 of year 3 depreciation expense. A not-for-profit's investment portfolio generates $80K of gross investment income during the year. The organization incurs $6,000 of external investment management fees and $2,000 of direct internal investment management costs. Under U.S. GAAP, what amount of net investment return should be reported in the statement of activities? So I think the 2,000 should be included. I'm not sure about the external investment management fees. Let's try just the direct internal investment management costs. So it was both. Okay. Investment returns reported net of both external and direct internal investment expenses under current U.S. GAAP. So it was both. Both categories of investment expense, fees paid to outside managers and costs directly attributable to internal staff managing the investments, are netted against gross investment income to determine the single net investment return line item reported on the statement of activities. So subtracting both the $6,000 of external fees and $2,000 of direct internal costs from the net income correctly yields $72,000 of net investment return. I guess you subtract the 30K out. Okay. Consideration payable to a customer that is not in exchange for a distinct good or service received from the customer is treated as a reduction of the transaction price and therefore reduces the amount of revenue recognized. It's treated as a reduction of the transaction price and therefore reduces the amount of revenue recognized. Cool. Solstice Company held a debt security classified as trading. At the beginning of the year, the security's fair value was $80K. At year end, its fair value is $92K. Well, it's trading, so what is the effect of this change in fair value of the net income for the year? Since it's trading, I think it goes straight to net income. So it should be increased. Yep, since it's trading. Unrealized holding gains and losses on trading securities are recognized in net income in the period they occur, regardless of whether the securities have been sold. Now, if it was available for sale or held to maturity, it would not be recognized in net income. But because it was trading, they're measured to fair value each period with changes flowing through net income. So the 12K increase in fair value increases net income. Hmm. Hmm. Recognize an $80,000 loss in earnings for the period. Okay, under ADC 805, changes in the fair value of contingent consideration classified as a liability are recognized in earnings, not as a goodwill adjustment. Are recognized in earnings, not as a goodwill adjustment. The change stems from post. Recognized in earnings, not as a goodwill adjustment when the change stems from a post-acquisition event. The $80,000 increase is driven by post-acquisition revenue trends, which is a new economic event. So ASC 805 requires the change in fair value of the contingent consideration liability to flow through earnings as a loss. Good to know. The equipment has a 7-year useful life at fair value at $220,000. Okay, I think it's the lesser of the two, so I think it's B. Yes, because the present value of lease payments is approximately 90% or more of the fair value of the asset, which is one of the 5 criteria, see the owns criterion, that makes it a financing lease. If none of these were met, it would be an operating lease, but because one of these was met, which is the NPV of payments is greater than or equal to 90% of fair value, then it's a finance lease. If that wasn't met, it would be an operating lease. Tamarack Company self-constructs a building during year 1. Its weighted average accumulated expenditures for the year are $2 million. What amount should Tamarack capitalize for year 1? Not sure. Okay, let's see why. Avoidable interest is computed by applying the specific borrowing rate first, then the weighted average general rate to any remaining accumulated expenditures capped at actual interest incurred. So you do the specific loan layer, which is 1.2 million times 6%, plus the excess expenditure layer, which was the difference of those two times the 9%. And you add those two together, which equals 144,000, which is below actual interest incurred and is fully capitalized. Awesome. Under US GAAP, which of the following short-term, highly liquid investments qualifies as a cash equivalent? Should be T-bill. Yep, a U.S. Treasury bill purchased 3 months before maturity. And the reason it is a cash equivalent is because the maturity is 3 months or less. So cash equivalents are short-term highly liquid investments. Generally, investments with an original maturity to the entity of 3 months or less. If it was more than 3 months, it would not have been a cash equivalent, but because it was 3 months or less, it's considered a cash equivalent. A debt service fund makes a scheduled payment on outstanding general obligation bonds consisting of $200,000 of principal and $30,000 of interest, both due and paid on the fund's fiscal year end date. Modified accrual accounting. We're talking about expenditures. I think for the modified accrual accounting, they're not expensed until they're actually paid. So I would say 0. Okay. Okay, when due, not when paid. Under modified accrual accounting, debt service expenditures for principal and interest on long-term general obligation debt are generally recognized when due rather than accrued in advance. And because both the principal and interest were due and paid exactly on the fiscal year-end date, both are recognized as expenditures of the current period. I guess I didn't think about it being due at year end. It didn't really specify, or it being year end when we were classifying this. But yeah, so both the 200 principal and 30 interest are due and paid exactly in the fiscal year end date. So modified accrual accounting requires the debt service fund to recognize the full $230,000 as expenditures for the period. An engineering firm enters into a $2 million contract to build a facility. Expected value method best predicts the consideration. Okay, I think you multiply these three and add them, so it would be. I think I'd go 60% of 300 is 180. 30% of 150 plus 180 is 225. Plus 0 is 225. And then add them. Awesome. Under the ASC 606, variable consideration is estimated either using the expected value or most likely amount method, whichever better predicts the consideration to which the entity will be entitled and included in the transaction price to the extent it is not subject to constraint. And because this was the expected value method, you basically multiply the probabilities times the bonus amount. And then you add them up. So I think if it were the most likely amount method, it might have just been 2.3. So it might have been A if it was the most likely amount method, but because it's the expected value method, or the most likely amount method might have been it might have just been the 300. Anyway, it's the expected value method, so you do that. Awesome. A company declares a cash dividend of $360,000 to be paid to its common shareholders. The company has 10,000 shares are held as treasury stock and do not receive dividends. Was a dividend per share paid to outstanding common shareholders? Let's see, of which 10,000 shares are held as treasury stock. So I guess you do 360 divided by 90,000. 360 divided by 90 is 25%. Which is 4. Yeah, so you subtract out the shares that are held as treasury stock because they don't receive dividends, and then you divide the cash dividends by the number of shares outstanding to get EPS. So 360,000 divided by 100,000 minus 10,000, so divided by 90,000 is 4. Awesome. Retail company accounts for its inventory using the perpetual system and the FIFO cost method. At year end, the company performs a physical count and discovers a shortage of 100 units of product X. The purchase price of the most recently acquired units of product X was 75. Current price of 82. Accounting for the inventory shortage. So the purchase price of the most recently acquired units was that. Current price. I think it would be 75 times 100. Oh, no, sorry. I was thinking about LIFO. FIFO would be 60 times 100, so 6,000. So it'd be B or D. Let's see. Well, think you would record an inventory loss. I think you would do that. Yeah. So write off 100 units at the FIFO cost of the units that would have been sold and adjust cost of goods sold. Under perpetual FIFO, because FIFO is first in, first out. I don't know why I was thinking LIFO. So FIFO, first in, first out, a physical inventory shortage is written off the historical cost of the oldest units because FIFO assumes the oldest costs are consumed first. Yeah, so the basically cost of the oldest units remaining on hand. Yeah, that wouldn't make sense because those are the ones that you're recording a loss for, not the ones remaining on hand. So write off 100 units of the FIFO cost of the units that would have been sold and adjust cost of goods sold. Correctly charged to cost of goods sold with a corresponding credit to inventory. Corresponding credit to inventory. Cool. The company acquires equipment by issuing a $200,000 note payable directly to the seller. No cash is exchanged in the transaction. Company acquires equipment by issuing notes payable. Is that okay? So it would be inflow for investing. Well, hold up. Acquires equipment by issuing notes payable. Never mind. Yeah, it'd be non-cash. It'd be B. Yeah, because no cash is being transacted. It's just the equipment and the notes payable. So just neither of which involved to say no cash is exchanged in the transaction. Significant non-cash investing and financing transactions are excluded from the body of the statement of cash flows, which reports only actual cash flows, but must be disclosed separately either in a supplemental schedule or the notes. Precisely, because they're not involved in cash and therefore cannot appear within the statement's cash flow sections. Corporation reported net income of that and had a weighted average number of shares outstanding. Yeah, it's easy. Wish they were all like that. Yeah. All right. On January 1st, year one, Ridgecrest Oil drills a well costing $500K. It's a tough one. So it's the present, which that's easy because the answer choices are just straight numbers. So that's pretty obvious. But it's the present value for a single sum times the estimated cost of restoration amount. An asset retirement obligation is initially measured at fair value, the present value of estimated future retirement costs discounted at the credit adjusted risk-free rate. So it's that times the estimated cost of restoration. So oil well asset as a retirement component and then as a retirement obligation. Then accretes at 8% annually until settlement. So then 8% of that is debited every year. So I guess it would be ARO as a debit and cash as a credit for the next 10 years until that's gone. Cool. Under ASC 958, which criteria must contributed services meet before a not-for-profit entity recognizes them as both contribution revenue and an expense or asset? Yeah, what's this? The services create or enhance a non-financial asset or require specialized skills are provided by someone with those skills and would otherwise be purchased. Permits recognition of contributed services only when they create or enhance a non-financial asset or when they require specialized skills possessed by the provider and would otherwise need to be purchased by the organization. So either asset creation or enhancement or specialized skills that would otherwise be purchased. All right, 3 more. Under GASB, statement number 84, which of the following funds should be classified as a fiduciary fund? No, that's capital projects fund. That would be maybe like a special revenue fund. Enterprise fund is too easy. I think it would be this one. Yeah, a pension trust fund that holds assets for the benefit of retired city employees. A pension trust fund holds assets in trust for retired city employees, outside parties, satisfying GASB's core fiduciary criterion that the government controls resources belonging to others. During the year, a company issued 5,000 shares of preferred stock for 40 and separately repurchased and retired 100 or 1,000 shares of own common stock for 25. What amount should the company report as net cash provided by financing activities? So 5 times 40 is 200,000 minus 25,000, 175,000 should be. Yeah, preferred stock, common stock, doesn't matter. Both the issuance of preferred stock and the repurchase of common stock are financing activities. The cash inflow from issuance and the cash outflow from repurchase are netted together to determine net cash from financing activities. Yep. City Council formally adopts an ordinance restricting $300K of general fund resources for a specific future public safety initiative, a constraint that can only be removed by another formal council action. Under GASB standards, how should this $300K be classified within fund balance? I would say restricted fund balance because the constraint was imposed externally by a third party such as a grantor or law. Oh, okay. Interesting. A city formally adopts an ordinance restricting $300K of general fund resources for a specific future public safety initiative, a constraint that can only be removed by another formal council action. Committed fund balance because the constraint was imposed by formal action of the highest level of decision-making authority. Committed fund balance reflects constraints imposed by formal action of the government's highest level of decision-making authority, and that constraint can only be removed by an equally formal action. So I guess it's a higher decision-making authority than restricted fund balance. Non-spendable resource, non-spendable form. A formal ordinance passed by the city council, the government's highest decision-making authority, that can only be reversed by similarly formal actions defining characteristics of committed fund balance. So it's not B, let's see, because restricted fund balance arises from constraints imposed externally, not from the government's own internal formal action, which instead creates committed fund balance. So internal government, so a city council. A city council would be considered internal. Or I guess city council would be considered the government's highest decision-making authority. So it was internally rather. If it was externally, it would be restricted, but since it was internally, it was committed fund balance. Because the constraint was imposed by formal action of the highest level of decision-making authority. And that's time, but let's try to end on a make here. So Apex, so it's consulting services for a fixed fee of $400K plus a bonus of $100K. Expected value method. If the client receives a 15% reduction, it's considered they earn comparable bonuses of approximately 80% as such. All right, let's go with 100,000 times 80%, which is 80,000, and then the other 20% would be $0. So you wouldn't add anything there, so it should be 480,000. Nice. 480,000 calculated as a fixed fee plus 80% of the bonus. Not highly probable. The variation constraint does not reduce this. Fixed fee of $400K plus the expected value of the bonus correctly yields $480K under the expected value method with no constraint reduction. I feel like I remember this one though. Let's see, carrying amount. The impairment test, I think it's when carry amount is greater than, we'll see, not 900 minus 150 is 850. I mean, this would be 750, 120. I think carrying amount has to be greater than the present value subtracted from goodwill for it to be considered impaired. Let's see. Carrying amount. I think it is 80. Let's see. Yeah. All right, let's see why. Under the simplified one-step goodwill impairment test, impairment is measured as the excess of the reporting unit's carrying amount over its fair value, limited to the total amount of goodwill allocated to that reporting unit. So carrying amount of reporting unit is 900. So you do include the goodwill. And then carrying amount is greater than the fair value by 80,000. So excess carrying amount over fair value is 80,000. Goodwill allocated to reporting unit. Okay. because the 80,000 excess of carrying amount over fair value is less than 150K. The impairment loss is limited to 80K rather than the full goodwill amount. Yeah, so impairment is recognized when the carrying amount is greater than the fair value amount. And you don't subtract the goodwill out. So 900 is greater than 820. Therefore, it's impaired by 80,000. I want to get one right now. Let's see. The acquired company agrees to pay target former shareholders an additional 40K. Acquirer determines the working capital exceeds the target and estimates the fair value. This true up obligation 35. Nice. Include the $35,000 in the consideration transferred, like other contingent consideration. A working capital true up or a similar is a form of contingent consideration as included in is a form of contingent consideration and is included in the consideration transferred at the acquisition date fair value, consistent with the general treatment of contingent consideration. Working capital true-up obligation is a form of contingent consideration as included in the consideration transferred at its acquisition date fair value of $35,000, consistent with general contingent consideration guidance. That's it. When you're in its normal operating cycle, whichever is shorter, I believe. Under U.S. GAAP, a liability is classified as current if it's due to be settled within 1 year or the entity's normal operating cycle, whichever is longer. It's longer. Yeah, I just misunderstood that question. Yeah. Uses the longer of 1 year or the entity's normal operating cycle. Accommodating businesses whose operating cycle naturally exceeds a year. Which of the following fund types is used by a government to account for financial resources that are restricted or committed to expenditure for specific purposes? Yeah, special revenue. Special revenue funds account for the proceeds of specific revenue sources that are restricted or committed to expenditure for specific purposes other than debt service or capital projects funds. All right. We'll end it right there with 35 answers, 74%. I should have just stopped at 30. I would have had it. So technically I would have barely failed because it's 75% to pass. But anyway, there you have it. This is day 8 of taking the pricing for FAR using my own study tools that I've created. Let me know if you have any questions about the tool or whatever. 7-day free trial, no credit card required. If you want to use this, I think the UI is really nice and it's definitely a good supplemental option. So if you use Becker and just want extra practice questions, this is definitely a good option. But like I said, I'm actually trying to use this only and pass the whole CPA exam, which, I'm documenting my journey on YouTube. So subscribe if you're interested in that. But yeah, I mean, I'm trying to completely document this building process from start to finish and just kind of let you know if I can actually pass the CPA exam only using my study tool. But like I said, if nothing else, you can still use it as a supplemental study tool along with Ninja or Becker or UWorld or whatever else you use. So yeah, let me know if you have any questions and join the Discord, subscribe to the channel, and I will see y'all next time. Peace. Adios, friends.